$120,000.
Bitcoin this morning hitting a new high above $123,000 doing this right now.
A multi-trillion-dollar asset class, embraced by Wall Street, adopted by corporations. The United States government itself is one of the largest holders on the planet, seizing hundreds of thousands of coins from criminal enterprises. Bitcoin's success seems undeniable, but what if that success is a lie? What if the biggest financial phenomenon in our lifetime is actually a ticking time bomb built on a foundation of betrayal and containing a fatal flaw that almost no one is talking about? The story you've been told is that Bitcoin has matured, but the truth is it surrendered. It abandoned its original mission, and in its place, Wall Street has built a beautiful, gleaming Trojan horse. To understand Bitcoin's imminent collapse, we have to deconstruct the lie. This isn't a story about if it will crash, it's a story about how. To understand the betrayal, you have to go back to the very beginning. October 31st, 2008, Satoshi Nakamoto's goal was revolutionary: a peer-to-peer electronic cash system. Money without banks, free from government control. It was supposed to be for the people. So what happened? As Bitcoin grew, it hit a wall. The network was slow. A civil war erupted, the block size war. The digital gold camp, or small blockers, won, arguing the base layer should be a slow, secure settlement layer like a gold vault. Now, proponents will scream that is not a betrayal. That was the plan. They will tell you that fast, cheap payments were always meant for layer 2 solutions, like the Lightning Network. But this argument ignores two harsh realities. First, Layer 2 is a far more complex system that has seen nowhere near the adoption needed to be a global cash alternative. Second, and more critically, it doesn't solve the problem. By pushing transaction volume off of the main chain, it reinforces the idea that the base layer is just for holding. And that is a decision that directly threatens to defund the network's security from the inside out. The digital gold narrative was the perfect invitation for Wall Street. And in January of 2024, they arrived with Spot Bitcoin ETFs. The media hailed it as a victory, but it was a takeover. Remember the mantra: not your keys, not your coins. ETF investors don't actually own any Bitcoin. They own a stock ticker. The actual coins, over 1.1 million of them, are held in the custody of a few Wall Street appointed giants. Now let's be precise. This doesn't mean that BlackRock can change Bitcoin's code. The threat is more subtle: regulatory capture. When a handful of US-based companies become the custodians for millions of American voters' Bitcoin, they gain immense power to lobby and shape government policy. They are taming Bitcoin, transforming it from a revolutionary force into a compliant, sterilized asset in their portfolio. And this brings us to the most critical flaw in the system. The network is secured by miners who are paid by block rewards and transaction fees. The block reward is programmatically disappearing. In the long run, the network's entire security must be funded by transaction fees. The common defense is that a robust fee market will emerge from large institutions paying the high fees for settlement. But here's the uncomfortable truth. That is a hope and not a guarantee. Bitcoin's entire future security is being bet on a theoretical fee market that has never been tested at scale. If that gamble doesn't pay off, the security budget dwindles, the hash rate plummets, and the network becomes vulnerable to a catastrophic 51% attack. Now, the other defense that you will hear is that such an attack is economically irrational, but this assumes that every actor is motivated by profit. What about a nation state that simply wants to destroy the system? And for those who think you could just fix this later by changing the code, good luck. The 21 million hard cap is Bitcoin's most sacred promise. Trying to change it would spark a developer civil war that would tear the network apart far faster than any external attacker ever could. The problem is inescapable. So how does the final collapse begin? Not with a bang, not with a scandal. It begins with something that happens all of the time in healthy markets, a small, ordinary correction. A 5%, maybe 10% downwards trend. In any other market, this would just be a blip. But in a new hyper-financialized Bitcoin ecosystem, it's the spark landing on a $1 trillion powder keg. The powder keg is the crypto derivatives market.
On a single day last year, 12th of March, there were some massive price movements that took place. From $7,300 to $5,690, and from $5,800 to $3,900. These falls in price led to a large amount of liquidations taking place on the platform. Over 1.1 billion in contracts were liquidated.
This is the casino behind the casino, a $1.3 trillion per month shadow market where traders make leveraged bets on Bitcoin's price. Using instruments like perpetual swaps on unregulated offshore exchanges, a trader can use 100 times leverage. It's a system built on a hair trigger, and that 5% market dip is the finger pulling it. For a normal investor, a 5% dip is annoying. For a trader with 20 times leverage, it is a 100% loss. It is a liquidation event. Their position is instantly and automatically sold by the exchange. This is where the viral collapse begins. The first wave of liquidations from the 20x traders floods the market with forced selling, pushing the price down further, let's say to a 10% loss. This new lower price now automatically liquidates all the traders who were using 10x leverage. Another massive wave of forced selling hits the market. It's a mechanical, automated death spiral, turning a minor dip into a violent 25% crash in a matter of hours. In past cycles, this is where the carnage might have stopped, but not anymore, because this initial firestorm has just sounded a 5-alarm fire bell in the boardrooms of corporate America. That 25% crash started by the derivatives market is now a full-blown crisis for the companies that built their treasuries on the digital gold narrative. This crisis centers on Bitcoin treasuries, or the MicroStrategy playbook.
See, you can't create a bond that doubles in value over 8 weeks if you're not 100% Bitcoin. If Berkshire Hathaway sold the same bond and they were backed by $100 billion of T-bills, well, okay, it's zero coupon, it's convertible, but it's like, what's the point? The bond has no option value in it. The T-bills have a vol of 5, and MicroStrategy has a vol of 100, okay? So they've got no electricity in their bonds. So MicroStrategy is the leading issuer of Bitcoin-backed bonds in the world. And there's $300 trillion in the fixed income market that they can only buy bonds. But if you're gonna buy bonds, wouldn't you like the lowest risk, highest performing bonds? MicroStrategy is the most interesting, highest performing, most liquid securities. Why? Because we're volatile.
Pioneered by the company MicroStrategy, it is a radical corporate strategy where a company takes on billions of dollars in debt, not to build business intelligence solutions, how they used to make money, but to buy and hold massive amounts of Bitcoin on its balance sheet. The idea is to use Bitcoin as a hedge against inflation. The reality is that it transforms a regular company into a highly leveraged bet on the price of crypto. These companies are now facing a solvency crisis. That 25% crash isn't just a paper loss, it's a red alert for their creditors. It's the moment they risk breaching the covenants on their billions in corporate debt. A risk of covenant breach puts them potentially in default, giving lenders the right to demand immediate repayment of the entire loan. Unlike a regular investor who can simply hodl and wait for the price to recover, these leveraged companies don't have a choice anymore. To satisfy their creditors and avoid bankruptcy, they are forced to sell. And they have to sell into a market that is already in free fall. This is the inferno, the forced selling of hundreds of thousands of coins from the market's biggest corporate believers. A multi-billion-dollar liquidation event that craters the price even further. And it creates a second, more brutal downward spiral. The corporate selling pushes the price down another 10, 20, 30%, this deeper crash then triggers a whole new round of catastrophic liquidations in the derivatives market from any leveraged traders who survived the first wave. This, in turn, puts other corporations closer to breaching their own debt covenants, forcing them to sell. The pillars of the bull market, the institutional buyers and corporate treasuries, have become the very agents of its destructions. The ETFs and corporate buy-ins that felt like a stable, concrete on-ramp for capital are revealed to be a one-way door. In a crisis, there is no orderly exit, there is only a stampede. And who is left holding the bag? The millions of regular ETF investors who were told this was a legitimate, mature, safe haven asset. Bitcoin stands at a crossroads. To gain Wall Street's acceptance, it made a series of critical trade-offs. It traded the vision of a peer-to-peer cash system for the hope of becoming digital gold. It traded the principle of self-sovereignty for the convenience of an ETF. And it traded a proven security model for a dangerous bet on a future fee market that may never materialize. The title of this video isn't a prediction of a simple price crash. It is an analysis of a system that has introduced deep structural fragilities in its quest for legitimacy. The very mechanisms hailed as its greatest successes, corporate adoption and financial derivatives, have become the triggers for its potential undoing. The only question left is, what will be the spark that ignites the fuse? But what do you think? Is the bearish case stronger than ever, or are these just growing pains? Let me know your thoughts in the comments below. And if you want more deep dives into market dynamics, make sure to like this video and subscribe to the channel. And of course, thanks for watching.